Very good afternoon. Asian equities were largely higher on the day, although Japan registered losses on the day. The broader increase was driven in part by US inflation data out last Friday, meeting expectations as well as eased concerns around President Donald Trump's latest tariff announcements. The Nikkei share average declined by 0.7%. The Hang Seng Index jumped by 1.9%, while the Shanghai Composite Index closed up 0.9%. Wall Street saw all three major indexes close higher, breaking out of a three-day losing streak. The rebound came after the Fed Reserve's preferred inflation measure, the Personal Consumption Expenditure Index, rose by 2.7% in August, slightly higher than July's print of 2.6%. Looking forward, however, market players are concerned about whether congressional leaders will be able to have a meeting of minds on the budget to ensure that there isn't a government shutdown, with the deadline for those discussions set for tomorrow. The Dow Jones Industrial Average advanced by 0.65%. The S&P 500 rose by 0.6%, while the Nasdaq Composite Index gained 0.44% at the close. Looking at local indicators, we see that the all-share index hit a record this morning, touching 107,914 index points briefly, driven by gains in gold, PGM stocks and the broader resources index, with gold being the standout player. The all-share index is 0.7% higher as we speak at 107,518 points. The rand is trading at 17.28 against the US dollar, 20.24 vis-a-vis the euro and 23.19 against the British pound. Gold is trading at $3,812 an ounce, platinum at $1,609 an ounce, while Brent crude oil is trading at $68.03 a barrel. All right, let's get into it now with Gary Boyson. He's Director and Portfolio Manager at Rand Swiss. Thank you very much, Gary, for joining us. So market players are keeping a close eye on developments around this potential US government shutdown drama that's taking place. Why does this occur year in, year out, even though, of course, the Republicans are in the majority in Congress right now, and of course, this creates a lot of tension among market players, and there's always a sort of last minute or 11th hour resolution. Why does this happen year in, year out?
Yeah, so I think market participants definitely, I suppose, shrugging it off at this stage because we've become so used to this kind of brinkmanship. Looking at it, to keep the government funded, you need both the House of Representatives and the Senate to pass the spending bills, and then the president needs to sign them. Essentially, even if one party controls the House like the Republicans do now, even small divisions within that party, can block progress, and it allows small groups of lawmakers to essentially hold up progress and put forward, I suppose, you almost use it as a political bargaining chip on other legal frameworks that they're talking about. So they essentially use this leverage to it's politicking more than anything else. They're trying to get spending cuts, policy concessions, etc. Now, the actual consequences of a government shutdown, it's more politically damaging. It does highlight, I think, the dysfunction in the US system at the moment, just how, I suppose, polarized the US politics has become. And that's certainly watched by the rest of the world. And I mean, it can potentially explain some of the weaker dollar that we're seeing. But overall, as I said, broadly, indices are higher. If I look across in Europe, Paris and Frankfurt are both flat. We've got the UK market up slightly. So really, the market adopting a wait-and-see approach and really expecting that 11th hour deal. We know that, obviously, Donald Trump and the other congressional leaders will be meeting at the White House to try and find agreement today. And the Democrats, really, they want to see, I suppose, a funding plan. Well, at least the GOP wants to see a funding plan that doesn't include the Obamacare tax credits. But the Democrats want them, obviously, to cancel the cuts and are saying they want to save healthcare. So I think we are going to see a resolution. It is going to be right at the 11th hour. And it's kind of what we've come to expect from the US.
Yeah. So as a result of the uncertainty, some are attributing this to the gold price surging through the $3,800 an ounce level. It looks like it's marching towards $4,000 an ounce. Is this your assessment? And, this positive wave appears to be affecting everything, gold, silver, PGMs and so on.
Yeah, I think this is really a story of dollar weakness. If we look at the dollar index, we're trading around 98 at the moment. I mean, that's down almost 10% for the year against the six of the US's largest trading partners. And when you have the dollar weakening, the precious metals, the likes of gold, platinum, silver, really anything that's denominated in US dollars starts to look very, very good. And that even includes US stocks, for example. So, the US dollar could, potentially fears around the government shutdown that could be creeping into it. But also, we had very, very strong GDP data last week. I mean, it was very backward looking. It was for the second quarter. But you mentioned that PCE data as well. And I think that probably has more to do it. We are seeing inflation in the US starting to moderate, and that really is feeding into expectations of further interest rate cuts. So if I look at the pricing at the moment, there's around a 30% chance by December. So over the next two meetings, we'll get one 25 basis point cut, and there's a 68% chance that we'll get 50 basis point cut. So probably 25 at each of the next two meetings. Now, when the interest rates come down like this, suddenly gold becomes a relatively more attractive interest rate, because generally gold doesn't pay interest. So as the interest that you can expect on US dollar balances becomes less, gold becomes a relatively more attractive asset class. And I think it's probably more to do with the interest rate pricing than anything else. And investors are either going to hunt for yield, in other markets. They could be looking in the US stock market, but certainly not the bond market, but also looking at bond markets outside South Africa. And I think that's where we're seeing a lot of portfolio flow into South Africa. And one of the reasons that we've seen the South African rand picking up as much as it has.
Super. Well, we don't have much time, but very quickly, just in terms of investing in gold, platinum stocks and stuff, is it too late for people who want to invest there?
Oh, it's a great question. So looking at it, if I look at the all-share index year-to-date total return, it's all about gold and platinum. So top of the leaderboard, Sibanye up to almost 220%, DRD Gold up 200%. If I look at the top 10 movers, it's only Blue Label Telecoms and Process that aren't either a gold miner or platinum miner. So we're certainly feeling it in the stock prices. Now, whether these are still good investments, it's a difficult decision, because if the gold price keeps going up, that's largely outside of the control of these miners, and it really depends on how the miners choose to operate in this environment. So they really have two choices: either pay back the money to shareholders through share buybacks or dividends, or invest in new operations. And if you look at the environment at the moment, there are some new projects coming on stream. You can see some investment from the miners, but largely they're paying this out, which means that supply is still going to be constrained, which means that if we do continue to see a weaker dollar, we see a little bit of nerve specifically from the central banks, and gold does move higher, you're going to see a lot of that operating leverage moving into the bottom line of these businesses, and they can go more, but of course very dependent on where the gold price goes. If the gold price starts to fall, they have had a run up, and I think at $3,800 an ounce, these gold miners are being priced fairly. They're not particularly expensive, but they're not cheap either.
All right, Gary, thank you so much for your time and insights as always. That was Gary Boyson, he's Director and Portfolio Manager at Rand Swiss.